deductions for 2025 with examples plus FAQs. What are the most popular tax deductions for 2025? In short, they include the standard deduction, now $15,000 single slash $30,000 joint, plus a host of specific write-offs like home mortgage interest, state and local taxes, SALT, charitable contributions, medical expenses, home office costs, retirement contributions, and many more. This comprehensive guide will break down 37 plus of the top deductions available to individuals, small business owners, and freelancers in 2025, with clear examples, rules, and tips for each. Many taxpayers overpay each year simply because they miss out on deductions they're eligible for. The 2017 tax reforms doubled the standard deduction, leading to only 10% of taxpayers itemizing deductions now. But new 2025 tax laws have further expanded certain breaks. Whether you're a W-2 employee, a freelancer receiving 1099s, or a small business owner filing a Schedule C, understanding these deductions can save you thousands. Below, we'll categorize deductions by type: education, home office, medical, retirement, and more, explaining how each works, who qualifies, and how to avoid common pitfalls. U.S. federal tax rules are emphasized first, followed by notable state nuances. Why care? Taking full advantage of deductions means a lower taxable income and a smaller tax bill or bigger refund. Keep more of your hard-earned money by legally leveraging these tax breaks. Money bag, bigger refunds. Maximize every deduction to potentially save hundreds or even thousands on your 2025 taxes. Don't leave money on the table. Books expert insights. Understand complex IRS rules in plain language. We break down eligibility, examples, and forms, W-2s, 1099s, Schedule C, etc., so you can file with confidence. Rocket Strategic Savings. Whether you're an individual or small business owner, learn how deductions for home offices, retirement, education, and medical expenses can boost your financial health while staying compliant. Let's dive into the ultimate list of tax deductions for 2025, complete with examples and tips to ensure you maximize your tax savings while avoiding common mistakes. Standard deduction, your biggest tax write-off, no questions asked. Standard deduction, 2025, for most taxpayers, the easiest and most used deduction is the standard deduction. In 2025, the standard deduction is $15,000 for single filers, $30,000 for married filing jointly, and $22,500 for heads of household. This flat amount is a free pass. You subtract it from your income without needing to itemize specific expenses. If you're 65 or older or blind, you get an extra standard deduction, an additional $2,000 for single or $3,200 for married filers. New for 2025, seniors 65 plus also qualify for a senior bonus deduction of up to $6,000 extra, phasing out at higher incomes. This means older taxpayers get an even larger automatic deduction on top of the base amount. When to use it? You should take the standard deduction if your total of itemized deductions, like mortgage interest, state taxes, etc., is less than these amounts. The vast majority of taxpayers, roughly 90%, take the standard deduction because it's larger than what they could itemize. It's simple, no receipts or lists needed. The IRS essentially lets you write off this chunk of income with no questions asked, simplifying your tax filing. Example: a single freelancer earned $70,000 in 2025 and has only modest deductible expenses. Rather than itemize a few thousand in expenses, they claim the $15,000 standard deduction on their Form 1040. This reduces their taxable income to $55,000. Without doing anything special, they automatically save tax on that $15,000, worth about $3,300 in tax saved if they're in the 22% bracket. Every taxpayer gets to do this, unless they choose to itemize. Tip: always compare your potential itemized deductions total to the standard deduction. The IRS won't give you both. You must choose one or the other. Use the higher amount for a lower tax bill. If you're married or have significant deductible expenses, like a home mortgage, itemizing might yield more than the standard. Otherwise, standard is usually best. What to avoid? You cannot take the standard deduction and itemize in the same year. New filers sometimes mistakenly list expenses and take the standard, don't double dip. Also, note that if one spouse itemizes on a married filing separately return, the other must itemize too. No standard allowed for the other spouse in that case. Finally, remember that the standard deduction replaces the old personal exemptions. Those remain $0 under current law. So don't look for an extra personal exemption deduction. It's already factored into the larger standard deduction. SALT deduction, state and local taxes, property and state tax write-offs. One of the most popular itemized deductions is the state and local tax, SALT deduction. This lets you deduct certain taxes you paid to state and local governments, specifically state/local income taxes or sales taxes, plus property taxes. What's allowed? You can deduct state and local income taxes withheld from your paychecks or estimated taxes you paid, or instead deduct state and local sales taxes. Useful if you live in a no-income tax state or made big purchases. The IRS provides optional sales tax tables plus large purchase add-ons. In addition, you can deduct property taxes you paid on real estate, your home, land, and personal property taxes. For example, some states' annual car registration taxes based on vehicle value. Cap and new changes. The SALT deduction has a cap. From 2018 through 2024, it was capped at $10,000, $5,000 if married filing separately, which meant even if you paid $20,000 in state taxes and $8,000 in property tax, you could only write off $10,000. Good news for 2025. A new tax law raised the SALT deduction limit to $40,000 for singles and joint filers, and $20,000 for married filing separately, for tax years 2025 to 2029. This is a huge increase, allowing many homeowners in high tax states to deduct much more of their state taxes. Note, for very high income taxpayers, over $500K single/$750K joint, this higher SALT cap starts to phase out, but most people will get the full benefit. Example, you're a homeowner in New York with $15,000 of state income tax withheld in 2025 and $12,000 in property taxes on your residence. Under prior rules, you'd be limited to a $10,000 deduction, but in 2025, you could deduct $27,000 of these SALT taxes, fully within the new $40,000 cap. This $27,000 will count toward your itemized deductions on Schedule A. If you're in the 24% tax bracket, that deduction could save you about $6,480 in federal tax. If your SALT total exceeded $40,000, you'd stop at the cap. Important, you must itemize to claim SALT deductions. If you take the standard deduction, you cannot deduct state or property taxes separately. Also, you can't deduct federal income taxes paid. SALT is only for state/local taxes. A few states allow a deduction for federal taxes on the state return, but not vice versa. What to avoid? Double counting and wrong year payments. You can only deduct taxes in the year you actually paid them. For example, if you prepaid your property tax for 2026 in advance in 2025, that early payment generally won't give you a 2025 deduction. The IRS disallowed a lot of prepayments when the $10,000 cap was first introduced. Also, for the sales tax option, you can't deduct both income and sales taxes. Pick whichever is higher. Most people use income tax paid, unless they made a major purchase, like a car or boat, or live in a state with no income tax. Tip: keep an eye on state refunds. If you deduct state income taxes and then get a state tax refund, that refund may be taxable income next year because you deducted those taxes. It's not a bad thing, just something to remember for next year's return. And note, property taxes on rental properties or businesses are not deducted here on Schedule A. Those go on the Schedule E or C for your business, which is actually even better as they're fully deductible without the SALT cap in that context. Mortgage interest deduction. Turn homeownership into a tax break. For homeowners, the mortgage interest deduction is often the single largest tax deduction. If you have a mortgage loan on your home, the interest you pay each year is deductible if you itemize. How it works. You could deduct interest on up to $750,000 of mortgage debt for mortgages taken out in 2018 or later. For older mortgages from before December 15th, 2017, a higher $1 million debt limit still applies. This interest can be on your primary residence and one other home, like a vacation home. It covers loans used to buy, build, or substantially improve the home. Interest on home equity loans, or HELECs, is also deductible only if the loan was used to improve the home or build a home, not if you used it to pay off credit cards or other personal expenses. What's included? Your mortgage lender will send you Form 1098 showing the interest you paid for the year and points, if any. Points, prepaid interest, you paid when getting the mortgage are generally deductible too, either all at once if it's for your primary home purchase or over the life of the loan for refinance. Also, interest on private mortgage insurance, PMI, was deductible in past years, but that specific deduction expired for now. Only mortgage interest counts in 2025 unless Congress renews the PMI write-off. Example: you bought a house in 2025 for $500,000 and paid $20,000 in mortgage interest for the year. Your lender's 1098 form reflects this. You also paid $3,000 in property taxes and gave some charity donations. In total, your itemized deductions could be $20,000 mortgage interest plus $3,000 property tax within SALT limit, plus, say, $2,000 charity equals $25,000. If you're single, that's well above your $15,000 standard deduction. So itemizing makes sense, and the mortgage interest is largely why. That $20,000 interest deduction at a 22% tax rate saves you about $4,400 in tax. Homeownership literally paid off at tax time. Key IRS rules. The home must be a qualified residence, primary home, or one second home. The loan must be secured by the home, meaning it's a mortgage or deed of trust. You can't deduct interest on a personal loan even if you use the cash to buy a house, since it's not secured by the property. There's also a rule that interest on debt beyond the $750,000 limit isn't deductible. For example, if you have a $950,000 mortgage on a new home, only 79% of your interest is deductible, $750/$950 of it. The bank will still report all interest on the 1098, but you should only claim the allowed portion if you exceed the limits. What to avoid? Mixing personal and home-related interest. Interest on credit cards, car loans, or other personal debt is not deductible, with a special exception for new 2025 car loan interest, which we cover later. Don't try to claim interest on a personal loan as mortgage interest. It won't fly. Also, home equity loan interest is a common area of confusion. If you took a home equity loan and used it to remodel your kitchen, that interest is deductible. If you use it to go on vacation or pay college tuition, it's not deductible under current rules. Additionally, rental property mortgages are handled differently. If you own rental real estate, you do deduct that mortgage interest, but on Schedule E is a business expense, not on Schedule A. And if you co-own a home with someone who is not your spouse, say, unmarried partners or roommates buying house together, each of you can only deduct the interest you personally paid, often proportional to ownership. Make sure the total claimed between you doesn't exceed what's reported on Form 1098. Tip: there's no income phase out on the mortgage interest deduction. Even high earners can take it, subject to the debt limit. However, if you're subject to alternative minimum tax, AMT, note that state tax deductions get disallowed under AMT, but mortgage interest remains deductible under AMT for loans on your main or second home. This makes the mortgage deduction especially valuable even for higher income folks who lose SALT or other deductions to AMT. Charitable contributions. Lower your taxes by giving back. Donating to charity not only feels good, it can also earn you a tax deduction. Charitable contribution deductions allow you to write off donations to qualifying charitable organizations, usually 501(c)(3), nonprofits, churches, etc., if you itemize your deductions. What you can deduct: cash donations are deductible up to generally 60% of your adjusted gross income, AGI. If you give non-cash property, clothing, furniture, stock, a used car, etc., those are usually deducted at fair market value, with some limits, typically 30% of AGI for gifts of appreciated assets like stock. If you donate goods, make sure to get a receipt and value them reasonably. What would they sell for at a thrift store, for example? Mileage driven for charitable service, e.g., driving to volunteer, is deductible at 14 cents per mile in 2025. Documentation. For any single donation of $250 or more, you must obtain a written acknowledgement from the charity, showing the amount and that no goods/services were given in return or describing any benefit you got. For non-cash donations over $5,000, like a piece of artwork, you'll need a qualified appraisal attached to your return. You report donations on Schedule A, and if non-cash gifts total over $500, you'll also file Form 8283 with details. Example: you tithe to your church, donating $5,000 over the year, and also donate used clothing and furniture to Goodwill, estimated value $500. If you itemize, you can deduct the full $5,500. Suppose your AGI is $80,000. Your $5,500 of donations is well under 60% of AGI, so it's fully deductible. At a 22% tax rate, that saves you about $1,210 in taxes. Essentially, the government subsidizes part of your giving. The more you give within the limits, the more you can deduct. A win-win for you and the causes you support. New 2025 note: the recently passed tax law created a special deduction for cash charitable contributions for non-itemizers starting in 2026, $1,000 single/$2, 000 joint above the line. But for 2025, that above-the-line charity deduction is not in effect yet. So in 2025, you still need to itemize to deduct donations. Plan accordingly. If your charitable gifts plus other itemizables will exceed the standard deduction, itemizing yields a benefit. If not, some people bunch donations into 1 year to cross the threshold. What to avoid: overstating values or lacking proof. Common mistakes include trying to deduct the full original price of items you donated instead of their current thrift value. That's not allowed. You must use fair market value, what a willing buyer would pay. The IRS often flags excessively high valuations of donated goods. Also, if you receive something in return for your donation, like a charity dinner or a gift, you can only deduct the portion that exceeds the value of what you got. For instance, you pay $200 to attend a charity gala and the dinner value is $50. You can only deduct $150. The charity's receipt should spell that out. Always get receipts or acknowledgement letters, especially for larger gifts. And remember, donations to individuals, e.g., giving money to a friend in need or via GoFundMe, unless it's run by a qualified charity, are not tax deductible. Only gifts to qualified organizations count. Political contributions also are not deductible. Tip: if you have appreciated stocks or mutual fund shares, consider donating those directly instead of cash. You generally get to deduct the full market value of the stock and avoid capital gains tax on the appreciation, a double tax benefit. This works for itemizers up to the 30% of AGI limit for appreciated property. Coordinate with your charity. Many have brokerage accounts to accept stock donations. It's a savvy way to support charity and cut your taxes at the same time. Medical and dental expense deduction, relief for high health costs. large out-of-pocket medical bills can translate into a tax deduction, though this break is limited to those who itemize and have significant medical expenses. The medical and dental expense deduction lets you write off unreimbursed healthcare costs that exceed 7.5% of your AGI for the year. What counts? You can include a wide range of unreimbursed medical and dental expenses for you, your spouse, and your dependents. This includes insurance premiums you pay, if not through pre-tax payroll, copays, deductibles, prescription medications, doctor and hospital bills, dental treatment, vision care, glasses, contacts, eye surgery, mental health therapy, medical equipment, wheelchairs, hearing aids, and more. Even things like travel costs to medical appointments, mileage at 21 cents per mile in 2025, plus parking slash tolls, and certain home modification for medical reasons, e.g., installing ramps, can qualify. Threshold. You only get a deduction for the portion of total medical expenses that exceeds 7.5% of your AGI. For example, if your AGI is $100,000, the first $7,500 of medical bills, 7.5% of $100,000, is not deductible. You need expenses above that to claim anything. This threshold means the medical deduction primarily helps people with very high medical costs relative to income, often due to major surgeries, chronic illness, or low income with moderate expenses. Example: a married couple has AGI of $80,000 in 2025. They had high medical bills, $10,000 in hospital and doctor bills after insurance, $3,000 in prescription drugs, and $2,000 in dental work, totaling $15,000 out of pocket. The 7.5% of AGI floor is $6,000, 7.5% of $80,000. They can deduct the portion above $6,000. Their excess is $15,000 to $6,000 equals $9,000 potentially deductible on Schedule A. If they itemize, that $9,000 write-off could save them around $2,000 in taxes, assuming a 22% marginal rate. It doesn't refund all their medical costs, but it softens the blow. Important details: only unreimbursed expenses count. If insurance or an HSA/FSA plan paid or reimbursed you, you can't deduct that part. Also, non-prescription meds, except insulin, and general health items, vitamins for general wellness, over-the-counter supplements, aren't deductible. Neither is cosmetic surgery unless it's medically necessary. For instance, reconstructive surgery after an accident or mastectomy would qualify. A facelift for appearance would not. What to avoid: trying to deduct expenses that don't qualify. Common errors include attempting to deduct the cost of basic over-the-counter meds, health club dues, or elective cosmetic procedures. These are not allowed. Also, double dipping is a no-no. If you pay medical expenses out of a tax advantage account like an HSA, health savings account, or FSA, flexible spending account, you've already got a tax break, so you cannot deduct those expenses again on Schedule A. Similarly, if you later get reimbursed by insurance for something you deducted, you have to include that reimbursement as income in the year you receive it, or reduce that year's deduction. Tip: keep detailed records of medical expenses throughout the year, receipts, mileage logs, etc. Often people don't realize how much they spend on assorted copays, prescriptions, and supplies until they add it up. If you're near the threshold, some year-end planning could help. For example, if you need an expensive dental procedure or new glasses, getting it before December 31st could push you over the 7.5% threshold for a deduction. Conversely, if you won't meet the threshold, sometimes bunching elective medical procedures into one calendar year to concentrate costs can yield a deduction that wouldn't be available if spread over 2 years. This is only worthwhile if you have flexibility and are close to itemizing anyway. Health savings account, HSA, contributions, triple tax benefits. An HSA is technically not an itemized deduction, but an above-the-line deduction, meaning you can take it whether or not you itemize. It's one of the most powerful tax advantage tools for those with qualifying health plans. If you have a high deductible health plan, HDHP, you can contribute to a health savings account and deduct those contributions. Contribution limits. In 2025, you can contribute up to $4,150 to an HSA for self only coverage or $8,300 for family coverage. Those were 2024 limits. 2025 might be slightly higher with inflation. If you're 55 or older, you get an extra $1,000 catch up. These contributions are deductible above the line on Schedule 1, meaning they reduce your adjusted gross income, AGI, directly. Triple tax advantage. HSA contributions are tax deductible. The money grows tax free. You can invest balances in mutual funds, etc., and withdrawals are tax free if used for eligible medical expenses. It's a deduction now and tax free spending later, a double win. Even if you don't spend the HSA money this year, you can invest and let it grow for future healthcare costs, even into retirement. Example: you're a freelance graphic designer with a high deductible health insurance plan. You contribute $4,000 to your HSA in 2025. On your tax return, you claim a $4,000 above the line deduction, line 13 of Schedule 1, for HSA contributions. This reduces your AGI from, say, $80,000 to $76,000. You've just saved perhaps $880 in federal tax, 22% bracket, and maybe additional state tax too. Meanwhile, that $4,000 in the HSA is available for any medical bills or can stay invested and grow. Essentially, you transformed out-of-pocket medical spending money into pre-tax money. Eligibility: to contribute to an HSA and take the deduction, you must be enrolled in a qualifying HDHP, one with a higher deductible meeting IRS criteria, and not be enrolled in Medicare or another first dollar health coverage. You also cannot be claimed as someone else's dependent. If you meet these, the HSA is a fantastic deduction. What to avoid: exceeding contribution limits or spending on non-medical items. If you contribute over the limit, you'll face penalties unless you withdraw the excess promptly. And HSA funds used for non-medical purposes before age 65 are taxable and subject to a 20% penalty. Plus, you lose the deduction on that portion. So ensure you use HSA money for qualified medical expenses, which are defined similarly to the itemized medical deduction items. Keep receipts in case of any questions. Also, note that flexible spending accounts, FSAs, if you have one through an employer, are different. Those contributions typically come out pre-tax from your paycheck and aren't deducted on your return. They're already excluded from your W-2 income. You generally can't double up an FSA and HSA in the same year, with some limited exceptions for specific kinds of FSAs. Tip: contributions to an HSA can be made up until the tax filing deadline, April 15th, 2026 for 2025 taxes, and still count for 2025. If you find a tax time that you have room to contribute and could use the deduction, you can still put money in before filing. And unlike FSAs, HSA funds roll over indefinitely. There's no use it or lose it annually. This makes HSAs not just a tax deduction, but also a supplemental retirement medical fund if you can afford to leave the money untouched for now. Self-employed health insurance deduction, special break for business owners. If you're self-employed, including freelancers, independent contractors, or partners in a partnership, you may be able to deduct 100% of your health insurance premiums for yourself, your spouse, and dependents above the line. This is known as the self-employed health insurance deduction. Who qualifies? You must have a net profit from self-employment, Schedule C, Schedule F for farmers, or K, one income from a partnership where you're active. You cannot be eligible for any employer-subsidized health plan, for instance, through a spouse's job. If you have access to another plan, you can't take this deduction. What's covered? Health insurance premiums you pay for medical coverage, dental insurance, and long-term care insurance, with some age-based limits on LTC premiums. It also includes premiums for coverage for your family. This deduction is taken on Schedule 1 above the line, reducing your AGI. Example: you run a small consulting business as a sole proprietor and earn $60,000 net in 2025. You purchase your own health insurance and pay $6,000 in premiums for the year for a policy covering you and your child. Because you're not eligible for any other group health plan, you could deduct the $6,000 in premiums as an adjustment to income. This could save roughly $1,320 in federal tax, if in the 22% bracket, plus self-employment tax savings in some cases, because a lower AGI can slightly reduce SE tax through a chain effect. It effectively makes your health insurance premiums paid with pre-tax dollars, just like an employee with job-based insurance enjoys. What to avoid? Make sure you don't claim the same premiums as a medical itemized deduction if you use this above-line deduction. No double dipping, it's one or the other. In practice, most self-employed folks use the above line because it's more beneficial. It lowers AGI, which can affect other deductions/credits favorably, and you don't need to meet the 7.5% AGI threshold like itemizing medical. Also, you cannot deduct more in premiums than your net business profit. For example, if your Schedule C shows a $4,000 profit and you paid $6,000 in premiums, your deduction is limited to $4,000. You can't create or increase a business loss with this. If you have multiple sources of self-employed income, coordinate the deduction with those profits. Tip: this deduction also applies to self-employed people on Medicare. If you're running a business after age 65 and you pay Medicare Part B, Part D, or Medigap premiums, those count as health insurance premiums that can be deducted under this rule. It's a nice perk, turning what is usually a personal expense, Medicare premiums, into a business-related adjustment to income if you have self-employment income. Retirement contributions, traditional IRA, and 401k deduction opportunities. Saving for retirement can yield tax deductions too. The main avenues are traditional IRA contributions and 401k/403b contributions, which reduce taxable income. Note: Roth IRA contributions are not deductible. They're after tax, but traditional IRAs can be. Traditional IRA deduction. If you contribute to a traditional IRA, you may deduct up to $6,500 in 2025, limit for those under 50, $7,500 if 50 or older. However, the ability to deduct depends on your income and whether you or your spouse are covered by a retirement plan at work. If neither you nor spouse has a workplace plan, you could deduct the full amount regardless of income. If you're covered by a plan at work, the deduction phases out for higher incomes for 2025, roughly in the $75,000 to $95,000 range for singles, $125,000 to $145,000 for married filing jointly, subject to official inflation adjustments. If only your spouse is covered at work, but you aren't, the phase-out is higher, around $218,000 to $228,000 joint. If your income is above the phase-out, you can still contribute to a traditional IRA, but it becomes non-deductible. You'd then consider a Roth or backdoor Roth strategy, beyond our scope here. Example: IRA, you're a single filer with a salary of $70,000 at a job that offers a 401k, but you didn't contribute to it. You decide to contribute $6,000 to a traditional IRA for 2025. Because your income is within the deductible range, and actually if you didn't contribute to the 401k, being covered means just eligible, which you are, so phase-out applies. You check the IRS limits and find you could deduct most or all of that $6,000. On your tax return, you take an above-the-line deduction for the IRA contribution on Schedule 1. This lowers your AGI by $6,000, saving perhaps $1,320 in federal tax, 22%. Essentially, you deferred tax on that portion of your income until you withdraw it in retirement. Plus, you're building your nest egg. 401k or 403b contributions. These are not deducted on your tax return per se. Instead, they're typically taken out of your paycheck pre-tax. For 2025, you can contribute up to $23,500 to a 401k slash 403b. Limit likely around that amount, plus $7,500 extra if 50 plus. Contributions will be reflected on your W-2 as lower taxable wages. While you won't list it as a deduction on Form 1040, it's worth mentioning because it reduces your taxable income just like a deduction. Many people maximize their 401k contributions to save for retirement and cut current taxes. If you're self-employed, a solo 401k or SEP IRA can allow even higher contributions, discussed later in the small business section. Example, 401k. You earn $100,000 and contribute $10,000 to your employer's 401k plan in 2025. Your W-2 will show $90,000 taxable wages instead of $100,000. Effectively, that $10,000 is a pre-tax deduction. You've saved roughly $2,400 in federal tax, assuming 24% bracket and perhaps state tax. Over time, this is a significant strategy to build wealth tax efficiently. Of course, you'll pay tax on withdrawals in retirement, but ideally at a lower rate or with decades of tax-deferred growth. What to avoid? Missing the IRA deadlines or eligibility rules. IRA contributions for 2025 can be made until April 15th, 2026. If you contribute to an IRA but are above the income limits for deduction, be careful to mark it as non-deductible on Form 8606. Otherwise, you might accidentally deduct when you shouldn't, leading to problems with the IRS. Non-deductible IRAs aren't necessarily bad. They create basis you can later withdraw tax-free or convert to Roth, but they must be reported properly. Also, you cannot contribute more than you earned in compensation. So if you only earned $3,000 of wages/self-employment income, that's your IRA contribution cap, even though the general limit is higher. For 401k-S, avoid not contributing enough to get any employer match. Not a tax issue, but a financial one. And don't confuse the traditional versus Roth. Contributions to Roth 401k or Roth IRA are not deductible, so know which type you're using. Tip: if you're close to a higher tax bracket or phase out for credits/deductions, contributing to a traditional IRA or 401k can lower your AGI and potentially keep you eligible for other tax benefits. For instance, some taxpayers strategically contribute to IRAs to drop their income just below a threshold, like for the student loan interest deduction or child tax credit phase-outs. Retirement contributions are one of the few last-minute levers you can pull to adjust your tax picture after the year end, especially IRA or solo 401k if self-employed. Just be mindful of the rules so you legitimately qualify for the deduction. Capital loss deduction. Offset gains and cut up to $3,000 of income. Investors, take note. If you sold stocks or other capital assets at a loss, you can use those losses to reduce your taxable income. Specifically, capital losses first offset any capital gains, and if losses exceed gains, you can deduct up to $3,000 of the net loss per year against your ordinary income. This is often called the capital loss deduction. How it works: say you had a bad year in the market and sold some investments at losses. You also might have gains from other sales. On Schedule D, you net your gains and losses. If you end up with a net loss, up to $3,000 of that can be used to reduce other income, like wages. Any excess loss beyond $3,000 carries forward to future years indefinitely. Example: you sold various stocks in 2025, ending up with a net capital loss of $10,000. You have no capital gains this year to absorb it. You're allowed to claim $3,000 of that loss as a deduction against your salary or other income on your 2025 return. This directly reduces your taxable income by $3,000, saving, for example, $720 in tax if you're in the 24% bracket. The remaining $7,000 loss carries over. On your 2026 taxes, you'll get to use another $3,000, and so on. If next year you have capital gains, the carried loss will first offset those fully, which could save you even more since it prevents gains from being taxed. Key points. The $3,000 limit